With Chapter 10, we start to bring together all the topics we've covered so far as we head toward the end game in this course, capital budgeting decision-making. We were very briefly introduced to the weighted average cost of capital in the last chapter. In Chapter 10, we cover how to find the weighted average cost of capital. What are the costs of capital that are included? How to find the component cost? How to adjust for flotation? How to adjust for risk? First, some definitions. The cost of capital to a firm is the return demanded by investors. The return on assets depends on the risk of those assets and how the market views that risk. Put simply, a firm must earn at least the cost of money on any investment it pursues. You wouldn't borrow money at 10% to invest in a project expected to return 8%. A firm requires capital from a variety of sources. Debt can come from both short-term notes payable and long-term debt. We would only consider notes payable as a source of capital if a firm uses it continuously as a source of funding, so we won't be including it in our study of weighted average cost of capital. Preferred stock is clearly a source of capital. Common equity capital can come from two sources: retained earnings and newly issued common stock. Capital comes from preferred stock, common stock, and debt. Accounts payable, accruals, and other sources of cash are not from investors. We adjust for them in the cash flows, which we'll look at that in Chapter 12. This is the weighted average cost of capital formula. The W factors are the weights, the percentage of each components that make up the funding of the firm. The R components are the cost of each type of capital, the cost of debt, the cost of preferred, etc. T is the firm's corporate tax rate. In this chapter, we'll look at how we arrive at each variable in this equation. Before we go further, two main points. Finance is concerned with after-tax cost. Only the cost of debt is adjusted for tax effects, since interest on debt is tax deductible. Second, the weighted average cost of capital is typically used to evaluate investment opportunities to be undertaken in the future. We usually aren't interested in what the cost of capital was last year. We need to know the cost of the next dollar of capital, the marginal cost of money to the firm. The weights used in the weighted average cost of capital formula represent the percentage of the firm funded by each source of capital. Should we use accounting numbers? Using book value is a last resort, since book value may not correctly reflect market value. Market value, that's the second best choice. The market value of equity is simply the number of shares outstanding times the price per share. Market value of debt is the number of bonds outstanding times the current selling price per bond. Actual numbers? You're going to have to be inside the firm to be able to get actual numbers. Outsider? Probably not. Optimal source for weights in the firm is the firm's own target capital structure. Let's work through an example to see how this works. Coleman Technologies has a 25% tax rate. They have bonds outstanding with a 12% coupon paid semi-annually and 15 years to maturity. They currently sell for $1153.72. We're going to ignore flotation. They have preferred stock with a 10% annual coupon currently selling for $111.10. Note that the $1 to $100 par value of the preferred stock is irrelevant in our calculations. We're concerned with what it sells for right now. Coleman's common stock is selling for $50 a share. Last dividend was $4.19, and they expect the dividend to grow at a constant 5% forever. We'll use the constant growth model from Chapter 9. Coleman stock has a beta of 1.2. Current yield on Treasury bonds is 7%. Market risk premium estimated to be 6%. CAPM, Chapter 8. Bond yield risk premium is estimated at 4%, and we'll talk about where this fits as we move through the example. Coleman's target capital structure is 30% debt, 10% preferred, 60% common equity. Beginning with the debt component. We already know the weight of debt, 30%. The cost of debt we need is the marginal cost, the cost of the next dollar of debt raised. That equals the yield to maturity on Coleman's current debt. And don't forget, interest on debt is tax deductible, so we adjust the cost of debt accordingly. With a maturity of 15 years and semi-annual coupons, N is 30. Coupon of 12% annually, $120 divided by 2, so the payment is $60. Current price is entered as a negative present value. Future value $1,000. Solve for IY is 5%. Remember, this bond is semi-annual, so we need to double the resulting IY to find the annual yield to maturity, 10%. To compare the cost of debt with the cost of other capital components, we need to view the after-tax cost. 10% times 1 minus the tax rate, 7.5%. We are going to ignore flotation cost. Moving across the equation, our next component is the cost of preferred. Again, we need a marginal cost, the cost to Coleman if they issued preferred stock now. Preferred dividends are not tax deductible, so there's no tax adjustment, and again, we'll ignore flotation cost. Recall that the formula for the cost of preferred is merely the basic constant growth formula with G equals 0. The equation uses current price, not the par value. Since most common stock doesn't have a par value, this doesn't come up with common, but preferred frequently does. The cost of preferred, $10 divided by 111.10, 9%. Preferred stock is riskier than debt. Remember the bankruptcy priority list. The order is debt, preferred, and at the bottom, common stock. So preferred is riskier than debt, but less risky than common stock. A firm can skip a preferred dividend, but they try not to. If they do skip a preferred stock dividend, they're precluded from paying any common dividends until the preferred ones are caught up. Plus, it's a signal that the firm doesn't have the cash needed to pay the dividends. To compare the costs correctly, we should compare the after-tax cost, and the after-tax cost of preferred, 9%, is higher than the after-tax cost of debt, 7.5%, which is consistent with the riskier nature of preferred stock. And the last component, cost of capital, equity. Equity can come from two sources. RS is the cost of retained earnings. RE is the cost of new equity. Recall that retained earnings belong to the shareholders. They just weren't paid out as dividends, but retained to reinvest in the firm. Retained earnings have an opportunity cost. If they'd been paid out, the shareholders could have earned a return on it. The firm could have repurchased its own stock and earned RS. So retained earnings are not free money. Easy, but not free. We have three methods to find an estimate of the cost of retained earnings. CAPM from Chapter 8, the discounted cash flow model from Chapter 9, and this new benchmark, own bond yield plus risk premium method. So let's start with CAPM. To find the cost of equity using CAPM, we need to find a proxy for the risk-free rate, typically the long bond, the 30-year Treasury, estimate a market risk premium, or determine a proxy for the return on the market, which is typically the return on the S&P 500. Find or calculate beta. Substitute these into the CAPM equation. For Coleman, the data was given. 7% risk-free rate, 6% market risk premium, 1.2 beta. Substituted in, our cost of equity, 14.2%. The CAPM approach does have advantages. It explicitly adjusts for risk. It can be used for any company that has a beta. However, virtually all the CAPM components are estimates or proxies. We're using historical data to estimate a future cost. To use the discounted cash flow constant growth model, we need three pieces of data. The current stock price, that's observable. The current last paid dividend, that's published data. The constant growth rate, that one we got to estimate. The growth rate is the one variable that we cannot observe. We have two choices. We could use historical data to estimate a growth rate, assuming that the future will be like the past. Or we can use analyst estimates. There are many published forecasts, Value Line, Yahoo Finance. But note, analysts usually forecast earnings growth, not dividend growth. They may not be the same. Using our given data, D0, just paid, $4.19, price, $50 a share, growth rate, 5%. Substituting those in, we get D1, 4.3995. There's where our growth rate in D0 goes. Putting that in the final equation, from Chapter 9, we get a cost of equity of 13.8%. The advantage of the discounted cash flow approach is in its simplicity. It's easy to use and easy to understand, but it only applies to companies that are paying dividends. and you must be able to reasonably assume the growth rate is constant. It doesn't consider risk, and it is extremely sensitive to the growth rate. Our third technique is a new one: own bond yield plus risk premium. This is not the same risk premium used in CAPM. Ibbotson and Associates compiles data on average returns for a variety of asset classes over time periods since 1926. AAA-rated bonds, AA-rated bonds, large cap stock, T-bonds. Assuming Coleman is a large cap firm and their bonds are AAA rated, the 4% is the difference between the average return on those two asset classes. This gives us a ballpark estimate useful for verification of the other more robust methods. In this case, 14%. So here are our three estimates. We might justify using the midpoint, 14%, or if we felt strongly about the quality of one estimate over another, we could elect to use it. Issuing new stock. The cost of issuing new common stock is greater than the cost of retained earnings. Issuing securities involves flotation costs, the cost of underwriting, legal fees, etc. When an established firm with common stock outstanding issues new equity, it's a negative signal to the market. The intuition is that it's the firm's last resort. Pecking order theory. A firm uses retained earnings first. If funds are still needed, they go to debt. It's less costly, no ownership dilution. Last resort, new equity. Stock prices move on news, and the announcement of a stock issue is news, not the actual issue. So when the issue is announced, the stock price may fall on the news, requiring the firm to issue more shares to raise enough funds. Adjusting for flotation cost has to use the discounted cash flow model. Continuing our Coleman example with the addition of a 15% flotation cost. The flotation cost is incorporated into the denominator of the constant growth model, reducing the price received by the issuer. The cost of new equity rises to 15.4%. Flotation costs for common equity are the highest since the asset is the riskiest. Flotation costs are often ignored for both preferred and debt since they're significantly smaller. Ignoring flotation cost and using the cost of retained earnings as the cost of equity, we substitute into the weighted average cost of capital equation and find a cost of capital of 11.6%. How can a firm affect its cost of capital? A firm cannot control market conditions such as interest rates or tax rates. If interest rates rise, the cost of all components rise. If tax rates rise, the weighted average cost of capital decreases because it brings down the cost of debt. A firm can control its capital structure. How much of the firm is funded with debt versus equity? More debt, less equity, brings the cost of capital down. A firm's dividend policy can affect its cost of capital, since paying out less means more retained earnings and less need to go outside for funding. And finally, a firm's investment policy affects the risk perceived by investors and their required return. You hear firms talk about their hurdle rate, the return that all projects must meet or beat to be accepted. But should the composite cost of capital be the hurdle rate? No. A firm's overall cost of capital reflects the required return on a project with the average risk of all the firm's projects. Different projects and different divisions have different risk. Cost of capital should be risk adjusted. This demonstrates the fallacy of using a flat hurdle rate. If a company didn't risk adjust, it would mistakenly accept Project H and reject Project L. If they do adjust, they will correctly accept L and reject H. This ends our coverage of Chapter 10, the weighted average cost of capital.